Welcome to Unit 6 of Topics in Governmental Financial Analysis, focusing this week on debt analysis. Up to this point, we've been talking about financial position, looked at inflows and outflows of resources. Now shifting gears a little bit and looking at the financial obligations that a government has and the demand on those inflows of resources that having that outstanding obligation and the requirement to satisfy it or repay it places on a government. We'll start the lecture out by looking a little bit at the different types of debt that governments have, not in any great detail. This isn't a course on municipal finance, but it's helpful to at least look at the variety of debt that is most commonly used by governments, so you have a sense of what they are if you don't already. We'll talk very briefly then about the motivation or the objective of debt analysis, and then spend the lion's share of the lecture actually looking at how debt is analyzed, almost entirely looking at general obligation debt and tax-backed debt, the type of analysis that would be done for that kind of debt sold by a general purpose government like a state or county or city. We'll wrap up toward the end looking at a little bit of revenue-backed debt analysis. We'll get into that a lot more later in the semester when we look at business type activities and the analysis of those types of entities. The king of municipal debt is the general obligation bond, or GO bond. Some people call them GO bonds. I find that to be a little weird. Certainly if you're talking with somebody involved in the market, they're going to say GO. This, at one point in time, was the only kind of debt that all but a handful of governments issued. This is debt that is backed by what is referred to as the full faith and credit of the government that is issuing the debt, meaning that is a strong backing. They're going to use all of their resources that are available to repay this debt when the payments come due. There's no particular revenue source that is secured for this debt. It is to be repaid from the general resources of the government. Tax-backed bonds are similar to GO debt, except they are connected with a particular revenue source, in this case, a particular tax. They may be backed by an income tax or a sales tax, maybe a special property tax levy, but general obligation bonds are usually the ones that are associated with the repayment using the property tax, considering how predominant the property tax used to be as a revenue source for local governments, and general obligation being predominant as the type of debt that was issued. You can understand how that connection developed over time, although now that revenue streams are more diversified and debt portfolios are more diversified, that connection might not be as straightforward as it used to be. But tax-backed bonds are going to be associated with a particular tax revenue, perhaps secured initially with one tax and backed up by another one if that first tax is not sufficient, or secured with a particular tax revenue with a backing of the general resources of the government. When you have that kind of secondary or backup revenue source that's available, those bonds are often referred to as double barrel bonds, referring to the primary and then the secondary revenue sources that are available to repay that debt. Revenue-backed bonds then also involve securing the debt with a particular revenue source, but now we're talking about non-tax revenues. Revenue-backed bonds are the ones that are going to be associated with business-type activities. So you have water bonds that are secured with the revenue of that is charged to consumers of water that's provided by the utility. Um, excuse me. Um, Perhaps it's parking facility, and so the parking fees that are charged to customers are securing the debt. I keep using this word secure, and perhaps it's worth saying something very briefly about that. Uh, Municipal debt might be referred to in general as a security, uh, meaning that there is a legal requirement to use a particular revenue source to repay that debt. The debt is secured or promised to be repaid from that particular revenue source. Um, Most debt issued by governments is tax exempt, meaning that it is not the interest on that debt is not taxed as part of the federal income tax. Generally, also not taxed in the state within which it's issued, if that state has an income tax, and then if it's issued by a city that has an income tax or a county that has an income tax of its own, it's not going to be taxable by that jurisdiction either. So if you ever hear a commercial on the radio for New York City, an upcoming New York City bond issuance, you might hear them say it's triple tax free, meaning it's tax exempt from the federal, state, and New York City income taxes. There are some cases, though, where it makes sense for a government to sell taxable debt just like a corporation would, or in which they're required to sell the debt as taxable debt. For instance, governments that issue um, pension obligation bonds, where they sell bonds and use the proceeds to provide resources to their pension fund that are then invested like any other resources of the pension fund to produce income to pay future benefits. Um, Under IRS rules, governments can't sell tax-exempt debt to do that, because essentially what they're doing is engaging in arbitrage, meaning they're counting on the fact that the return on those invested proceeds from the sale of the bonds will be a higher percentage than the interest rate on the debt. That's a good bet for them as long as the invested proceeds continue to earn more in income than they have to pay in debt service on those bonds. And because they're engaging in arbitrage, they're required to sell taxable debt for POBs or pension obligation bonds. Some debt, comes with a fixed rate, meaning, this is just like looking at a mortgage. If you've had any experience with a mortgage on a home, there are fixed rate mortgages where you're paying the same interest rate over the life of the mortgage, or in this case, over the maturity of the bonds. And then there are those that have a variable rate that is based on some market index. And as the market rate changes, the interest rate that you're paying on that debt also changes. I'd say governments predominantly used fixed rate debt, especially when you're talking about run-of-the-mill general purpose governments. But there are some cases where variable rate debt makes sense, and but it's something of a gamble. The government is counting on those variable rates not to rise, or not to rise too much. And as long as they don't, or they drop, it ends up being a good bet. If they go up, especially in comparison to what they might have been able to get as a fixed rate, that obviously isn't such a good bet. Variable rate debt also might be issued because the government is looking at engaging in a derivative instrument as well in connection with this debt issuance. For a time, governments were finding that it was less expensive to issue variable rate debt uh, in conjunction with a derivative instrument that synthetically or effectively created a fixed rate that they were going to pay, a fixed rate probably higher than whatever that variable rate debt was at that time, but it's locked in at that point and won't go any higher. It's kind of like a rate lock on a mortgage, and they found that that was actually cheaper than selling fixed rate debt at the rates that were available at that time. Of course, when 2008 came around, and derivatives, along with a lot of other financial instruments, started to melt like the witch and the Wizard of Oz. Uh, those arrangements didn't look as prudent as they did when they first entered into them. You're going to see, if you look at debt for any length of time, a long list of acronyms. I'm not going to get into all of those. COPs, or certificates of participation, which is a type of debt that is connected with long-term capital leases. VRDOs are variable rate debt obligations. Talking about what these are, goes well beyond the scope of this course, but suffice it to say that governments in general have been diversifying their debt portfolios over the last couple of decades, from having almost, all of their debt being general obligation debt, to expanding into revenue-backed debt for particular activities, tax-backed bonds, and this variety of other instruments like COPs and VRDOs and mortgage-backed obligations and things like that. And then I mentioned very briefly pension and I mentioned pension obligation bonds. There are also OPEB obligation bonds for governments that have an OPEB liability. And as I explained before, they sell these bonds. They put the proceeds of the sale into the pension plan, where they're invested long term to produce income. And the bet here is that the return earned on those invested proceeds is going to be greater than the debt service payments that the government has to make on those bonds. And then lastly, there's the issue of short-term debt. Everything we've been talking about on this slide up to this point is debt that is anywhere from, say, 10 to 30 years, sometimes longer. Short-term debt is issued for cash flow purposes, in anticipation of resources that are going to come in the near future. A government will even out or smooth out its cash flows by issuing short-term debt, often referred to as notes, and they use those proceeds in the near term, and then when the revenues or resources they're expecting come in, they use those to repay the notes. There are a variety of these. Again, they're acronyms. Accountants aren't the only people who are good at acronyms. Revenue anticipation notes, or RANs. Tax anticipation notes, TRANS. Tax and revenue anticipation notes, or TRANS. Bond anticipation notes, or a government might issue them to get cash flow in anticipation of selling long-term bonds. Bond anticipation notes, or BANs. There are also other variety that are used less frequently. GANs, grant anticipation notes, for instance, and so on. So moving on now, why would a government, someone interested in the financial health of a government want to analyze debt? Well, this obviously is the single largest liability on the books of most governments. Most governments are going to have two big liabilities: their outstanding debt and their pension and or OPEB obligation, except right now the only one that shows up in the face of the financial statements is the long-term debt. So if you're looking at a government and are interested in what kind of a burden its long-term liabilities place on it in terms of a demand for resources, a demand that is competing with the demand for service provision, which the government exists to do, how much is going to be required to repay that debt. How much of a burden is that on the government and on its constituents? You also want to know, just as when you're analyzing revenue, is do they have the capacity to issue more debt if they need to? Perhaps you've analyzed their capital needs and you see that there's a lot of infrastructure, very valuable infrastructure that needs significant work. Is this government going to be able to issue the debt needed to finance that construction? And is it allowed to? It's not just a matter of looking at their debt compared with their ability to pay. You also need to know, are they actually allowed to sell that debt under state laws and state regulations? Are they required to get somebody's approval, the citizens, a debt issuance, a debt issuance board at the state level? That's an important thing to know. You need to see capacity and authority or ability together. And then obviously the group of financial analysts most interested in debt are those that are connected with the municipal bond market, the bond raters, the mutual fund investors, the underwriters, the financial advisors, the bond attorneys, and so on. They look at this issue of debt affordability, within the rubric of credit worthiness. From their perspective, can this government make its debt service payments when they come due? Debt service, again, remembering that's interest plus principal. So let's look at debt analysis in general. There's a wealth of information if a government provides a CAFR in the statistical section. If they don't, you obviously have to build these databases up on your own by looking at individual years' financial reports. But if they do have a CAFR, there are a number of required debt schedules in the statistical section that are really valuable for debt analysis. This one is a schedule that shows all of the outstanding debt instruments that a government has, both those that are general obligation and tax-backed and draw on the general revenues of the government, and those that are revenue-backed connected with the business-type activities of that government. You can, initially in your analysis do some percentage changes. Here, looking at the most recent year in this schedule, this is the various debt instruments that this government has. It's a fairly diverse portfolio of debt. You divide each of them by the total debt outstanding, and you get your percentage distribution. And you can see for this government, general obligation debt is actually really small. That may be because there's some type of limitation on their ability to sell it. Perhaps they have to get voter approval for any general obligation debt issue, and haven't had much success in the past at getting the citizens to approve those during an election, and so they've moved on to look at other types of debt that perhaps don't require the approval of the citizenry. The next step you might want to do then, particularly looking at a government like this, where they started out with a certain number of types of debt and then added a lot of new types of debt over the 10-year period you're looking at, is to run those same percentage changes, percentage distribution for the first year in the trend as well, and then compare those side by side. So here's the first year, here's the most recent year. You can see the general obligation debt used to be a lot more significant, but not so much because of the amount outstanding in terms of general obligation debt, but because they issued a lot more debt of other types over that 10-year period, and so now by comparison general obligation debt is a small fraction. That redevelopment debt didn't exist at all, nor did the water or the term loan or the COPS, the certificates of participation. That was all new debt that was issued during the 10-year period. And so obviously those percentages change very significantly. And then the things that were big ticket items like lease revenue debt and special assessment debt uh, dropped considerably. I didn't mention special assessment debt in talking about the various types of debt. Special assessment debt, as you know, is debt that's repaid with a special assessment on a particular uh, part of a government's constituency, maybe a particular neighborhood or a particular area that is benefiting from the capital investment that is being financed with that debt. And so not the entire populace is paying for it, but just this subsection of the populace. Of course, looking at changes in the percentage distribution is similar or gets at the same kind of issue as calculating percentage changes, which you start by looking at percentage change in total debt, most recent year minus the earliest year divided by the earliest year, and you see that their outstanding debt more than doubled in that 10-year period. It increased by 120%. And then you might take a look at individual types of debt. What was the change in the GO debt versus the change in the business type activity, which we know, clearly there's a shift here. It may be the debt that or capital projects that were being financed with general obligation bonds at one time. Then they decided, well, let's start selling some revenue-backed debt secured by the revenue streams of those business type activities rather than financing that with the general resources of the government. So what is the magnitude of the debt outstanding? Like any other type of analysis, it's not sufficient just to look at the amount that's outstanding, but you need to put it in some type of context that allows you to compare it to other governmental entities, so you have a sense of the magnitude of the debt. And it just so happens that in this schedule, governments are required to show their debt as a percentage of personal income and as a percentage and divided by population or per capita. So you remember that the percentage change in the nominal amounts of the stated amounts of the debt was 120%. If you look at per capita, you see that it was actually much less growth, less than half the pace of growth, which suggests that a part of the explanation for the growth in debt is that the population of this government is growing, and the demands and the needs for debt financed capital investment have grown considerably as well. Plus, you've now got a larger or a broader tax base or populace to tax. The debt burden is spread over more people than it was at the beginning of the period, and therefore, all of the things being equal, appears to be more affordable. There's an additional schedule in the statistical section that looks specifically at debt that is secured with the general resources of the government, like general obligation debt. And so this is basically going to be a subset in some cases of what's shown under the governmental activities in that more encompassing or more comprehensive schedule that we just looked at. The idea here is that this is your general debt analysis. You're looking at debt that is going to be secured by the resources that are being used to provide services and to do other things that the government is required to do. This debt is most directly competing with service provision for those scarce resources. So you can do a percentage change looking specifically at this kind of debt, even though that general obligation debt has dropped considerably from almost $11 million in 2000 X0 to under 6,200 in 2000 X9. They have these redevelopment bonds, which added almost 5 times as much debt. And so overall, this debt secured by the general resources of the government went from almost 11 million in the first year to at one point 65 million in 2000 X4, and then has been being pared away little by little each year, and by 2000 X9 it's 57 million. You're also going to see some ratios here that give you a sense of the magnitude of this debt or the burden, percentage of the market value or actual taxable value of property, and then another per capita ratio as well. And you can look at those in terms of percentage change also to get a sense of what's happening with the government. So doing those percentage changes, looking at the stated amount, the nominal amount, that's a pretty significant increase over the period, all related to the introduction of these new redevelopment bonds. Calculate that same percentage change again on the per capita amount, and it's still pretty big, 250%, 3.5 times larger than in the first year, but not quite as big as 423.8%. And then if you look at that other ratio compared to the taxable value of the property, you see that the growth is still, large. It's more than tripling, 214%. But it's the base from which much of that debt is repaid, the property tax, is growing as well and making debt more affordable at the same time that they're issuing more debt and increasing the size of the burden. So they have more people living in this government over which the debt can be spread. The revenue source, the property tax, is able to produce more, all other things being equal. Remember, there may be some other issues there, as you know from the revenue analysis. There might be some limitations on how much they can increase that property tax. And so it's still a significant increase any way you cut it. But you can see that the ability to finance this debt burden may also have improved at the same time, although not at the same pace. Up to this point, we've been focusing on the debt that's issued by the particular government we're interested in. But debt analysis also looks at this concept of overlapping debt. We had talked during revenue analysis about overlapping tax rates or overlapping revenue rates, those that are applied to the same tax base or the same revenue base by governments that overlap at least in part geographically with the government you're interested in. And the same concept can be applied to debt, where you're looking at the debt that is issued by these governments that overlap geographically with the government you're interested in, and therefore is being repaid in part by some or all of the residents of the government you're concerned about. So for instance, you may be looking at a city and there are 3 different school districts within that geographical area, and so the constituents of that government aren't just repaying the debt of that government, but they're also responsible as taxpayers for the debt of those school districts. And if you want to know whether the constituents or the taxpayers of that government can bear any more debt, you also need to consider the fact that they're not just repaying your debt, they're repaying the debt of other governmental entities as well. And that's what overlapping debt gets at. It's not a substitute for looking at the direct debt burden as we have up to this point. It's an additional consideration. You can only get at this sort of on an average basis anyway, because you can't look at each of the individual residents and figure out which each of them is paying. But if you look at this debt as a whole and make some assumptions that allow you to figure out what percentage of that debt is applicable to the citizens of this jurisdiction that you care about, you can get a sense of this broader burden, as some context for looking at the direct debt of the government that you're concerned with. And you can see from this schedule in the statistical section that all governments are required to present that there are a number of school district debt issuances that are here. The county that this city is located in has debt of its own. And there are also not just geo debt from the county, but also a number of other kinds of debt as well. Governments aren't required to separate the debt like this, debt repaid with property taxes and other kinds of debt, but some will, and that if they do, or if you can figure out what which debt is listed in the schedule is like this, it's helpful if you're looking at geo debt in particular, or general tax-backed debt as well, to be able to to look just at those repaid with property taxes, for instance, as opposed to those that are repaid from other resources. What you see in the schedule is the total amount of debt outstanding for each of those overlapping governments, and then an estimate of the percentage that's applicable to the citizens of the government you're looking at. So, for instance, if you look at the county, unless the city and the county are identical in terms of their geographic area, and that does happen. Miami and Dade County, Florida, for instance, are contiguous. They are basically the same geographical area. But in most cases, any county is going to have a number of local governments within it, and in this particular case, looking at, I believe, property tax values, the city represents a little bit more than 10% of the total property tax value of the county as a whole. And that percentage then is multiplied against the debt outstanding for that overlapping government to get an estimated amount, or an estimated share of that outstanding county debt in this case, that is applicable to the citizens of this city. And then those are totaled up. You get total overlapping debt down here. Here's the direct debt for this government, the debt actually outstanding that it issued, and then there's a total direct and overlapping debt number here. And any of the ratios that you look at with direct debt, you can also calculate those same ratios with direct and overlapping debt. Again, you wouldn't want to do one of them and not the other. You're always going to want to look at the direct debt, and then you're going to want to look at overlapping debt as well in order to add some additional context to your analysis of direct debt. So here, looking at the overlapping debt, the amount outstanding, and then as per capita divided by population, there's the direct debt and the overlapping plus the direct debt for that government. I mentioned earlier that it's not sufficient just to look at capacity to calculate these debt ratios that give you a sense of debt affordability or debt burden. You also need to confirm that the government has the legal authority to issue that debt. And the schedule of debt limitations, it might be called the legal debt margin schedule, or the legal debt limit schedule. That's going to show you over time how much debt borrowing capacity a government has overall, how much of it is used, and how much is left over. So, for instance, what you can see here is this government is limited in terms of its ability to issue debt at 5.2% of the assessed value of real property. And although that used to be higher, apparently, it used to be 13% in fiscal years 2001 and earlier, but this period is all after fiscal year 2001, so it's not entirely clear why Anne Arundel County continues to report that fact. So you take their total assessed value, multiply it by 5.2%. Oh, I see. Now I understand. Sorry, I actually knew this and I just forgot it. Obviously, the outstanding debt they have now, some of it was issued in 2001 or prior. So the limit they have is of 5.2%, um, and then 13% for the earlier years to get the total debt limit. So this is the total amount this government was allowed to have outstanding in that particular year. Here's the debt that's applicable to the limit. That's something you may need to look into. What particular debt is covered by this limitation? In most cases, it's going to be debt that is paid with general resources of the government, geo debt, and taxed-back debt, and maybe some other kinds of debt. Anything that's usually it's going to be anything that's being repaid from the general revenue sources of the government. Although it may just be general obligation debt in some states, it will vary from state to state. So here's their total borrowing power. Here's the amount that they had outstanding. So they could have borrowed as much as $2 billion. They actually had $562 million outstanding, and so their legal debt margin is almost $1.5 billion. That's how much legal debt authority they had above and beyond what they had outstanding. And then they have a ratio here that looks at the total debt that is applicable to the limit divided by the debt limit. So you see that they've used up 27% of their legal authority, which means conversely they've got 73% of that legal authority left. Remember, though, you need to look at ability, legal authority, and capacity or affordability at the same time. So the fact that they could borrow legally another $1.5 billion may not mean that they could actually afford to do that. And that's why looking at these ratios in conjunction with looking at the affordability or debt burden ratios, you want to look at those in conjunction and neither one in a vacuum without looking at the others. What you can see over time here, because you've got 10 years worth of data, is that the portion of the debt limit that they're using declined. It went up again a little bit in 2011. That looks like there's some significant new debt that was issued in that year, and also the assessed value went down in that year. That's going to squeeze the ratio on the other side. If assessed value is going down, that's going to limit their borrowing power. But still, almost 20.5%, significantly lower, I think, than a little bit more than 27% at the beginning of the period.